Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. On Tuesday's Stock Play of the Day, we talked about Amazon. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a long call spread in Amazon. We basically took that strategy that we discussed in detail on Google a while back, and we said, well, now Amazon has decided they're also going to split their stock, keeping up with the Joneses, if you will. And so let's discuss the long call spread and how that would work with Amazon, considering that they're both very expensive stocks in general. So right now I'm showing a long call spread inside the options playbook. And the concept is on more expensive stocks, it's very hard to just buy an option outright. You buy an at-the-money option contract going out beyond the split, you're looking at spending $20,000, $30,000 just for one option contract. So we're going to look at using spreads to reduce that risk, but still give us some upside. So we talked a lot about the risk versus the reward. In Google, stock was down a little bit more. We did a ratio where our risk was about 30% of the maximum reward. With Amazon, we did a 50-50 trade, only to kind of change it up a little bit. So let's see what has happened with Amazon since Tuesday. A lot has happened overall. So I'm going to run over to the Ally Invest option chains. 1 second here. And this is a 15-minute chart showing that on noon on Tuesday, we always tape live the Stock Play of the Day. So since this is 15 minutes, this was all the way to the end of the day on Tuesday. So the market actually did run up for a minute, but it was only about a minute. And then we closed a little bit down based off of where it started on Tuesday when we kicked off the event. Then it traded down all day Wednesday, all day Thursday, little spike up, and now here's where we're at on Friday. 32.70, we're down around 108 points from the point that we put on the trade. Nothing to sneeze at here. So if we look at the markets real quick, I'm just going to highlight the markets just so that we have it on record. We see that the VIX is actually trading right around 20% implied volatility. We have the SPX down just a fraction. The IWM is actually up a little bit, where the NASDAQ is also down a fraction. So the VIX being down around 20%, I've talked about this many times. I just feel like that's a very low level considering all the volatility, potential volatility that is going on in the marketplace, inflation, the Fed raising interest rates, geopolitical concerns, just to name a few. So we're trading Amazon as a speculation play based off of the stock split. And hence the title last week, we're saying we are trading Amazon like it is 1999. And that's because that was the last time Amazon actually split their stock. So they're going through a 20-for-1 stock split. And we have targeted an expiration that is after that stock split. So I'm going to run over to the Ally Invest option chains. And yes, we are down on this position, but what is our strategy going forward? Well, we could exit the position, and because we have a lot of time value, we can get out at a minimal loss relative to the total cost of the trade. Now, in most of the time when I'm doing a strategy like this, I'm doing it for that known event that is going to happen quite a ways out in time. We're talking about July. The expiration was the June 17th expiration, which is 77 days away. So we're going all the way out to that June 17th expiration. And we have over 77 days for the underlying stock to move back. And because of that, we could sell and get out of the trade. I don't think I would look at an adjustment at this point. It has just happened where we had obviously some weakness in the stock, but I think I would stick around and try to hang with the trade. Now, I did mention on Tuesday's show that we're going to come back closer to the expirations of both of these option contracts, both of these strategies, I should say, in Amazon and in Google. And we'll look at maybe doing an adjustment closer to that known event. So right now on Tuesday, these options are obviously out of the money. When we started, this option contract was in the money on Tuesday. That we bought the 33.60 strike, and at the same time, we sold the 43.80 strike. We did this for a net debit of $58 to the account. So in that instance, you're talking about for every one-by-one spread that we're doing, we're paying $5,800 plus commission to get into that spread. Now, the width of the spread, the difference between the strikes here was 120. So you're looking at about a 50-50 risk. So you're paying 58. Overall, the maximum risk could be 120. So we set up a situation where we have about a 50-50 chance. Well, I should say the risk reward is about 50-50. I can lose 58 or I can make 62. And that's how we set up the trade to start with. And we talked a little bit about the nuances of doing that on Tuesday's show, if you want to go back and review it. So right now we see that it's trading at 46.63. So we're down $11.40. So we could sell it and get out. And like I said, even though the stock's down $100, because these are so expensive option contracts and there's so much time premium, that has a lot to do with actually Amazon's stock price and obviously some of the volatility that has been created by their stock split announcement. But you see, look at this option contract at the midpoint on the call that we've sold, it's $110. If we were to buy the 33.60, that is trading for $157. So we've greatly reduced the risk of doing this trade by spreading it off. But the market has gone against us. And so this option that we've sold is helping us out the most. We're lucky that we sold that because it's giving us some protection. So the stock's down $100, but the option strategy is down $12. Well, the stock's down about around $109 approximately. So we have accomplished our goal by doing the long spread in case we were wrong on our forecast. So maybe you just sell and get out. All right. I wasn't wrong. I was just early, which I think is always a fun phrase to hear analysts say. And that's a feasible solution. There is nothing wrong with that. And it's good that it happened right away, because that short option contract and the long option contract still have a lot of time premium, and that kind of works as a hedge in your strategy. If not, I would just let it ride. We know there's going to be volatility in the marketplace because of everything that I said. I'm very surprised that the VIX is still hanging around that 20% level, and it's not trading up near the 25, 26% level. As you know, the VIX index is a lot of times referred to as the fear index. And usually when the VIX is increasing, that means people are buying protection in the S&P 500 index, trying to protect portfolios. That's where the name the fear index comes from. So we have more volatility in Amazon than what the marketplace is implying, and that happened, but the volatility was to the downside. Hopefully we get some of that to the upside, and we'll come back and look at this trade. And I'm going to make a little note or a little reminder to come back a few weeks from now. Now, we always do the stock play of the day on the Friday following the initial paper trade that we talk about. But we'll come back, and there are some things that we could do to try to hedge this trade, but we're not that close to expiration where we have to panic and perform that hedge at this point in time. So the Google trade goes out all the way to August. We're going to come back and look at that trade too, but the concepts are the same. And that's what the stock play of the day and the options playbook is all about. We're trying to take one of the 40 strategies, apply it to a situation, and say, because of the underlying price of the stock in Amazon, because of the volatility, because of the known event, we're going to pick these strike prices and this expiration, and we're going to craft the option strategy to match the underlying. And by doing that, that's how we're learning about option trading. And that's what the stock play of the day is all about. All right, so we'll leave it at that. I guess the official stock play of the overtime paper trade is to do nothing, to let it run. If you are nervous, there's nothing wrong with getting out. And a lot of times getting out early, because it has definitely made a different move as far as the chart is concerned, right? 109 points even in Amazon is nothing to sneeze at. And because of that, I'm okay with getting out of the trade. If it was down a little bit, I would not even consider it, but it is down a lot. And so with that said, I think we're going to leave it. This will be, thanks for coming for today's stock play of the day overtime. Please click subscribe, please ring the bell, and please share this with all your friends and family. We love doing the stock play of the day. It's free for all, so please let them know, and you'll get an alert for the next stock of the play. The stock play of the day, and on Tuesday we'll be kicking it off at noon Eastern time. Thanks for coming, everyone.